Welcome to Value Research Helpline once again. Very eventful week, lot of regulatory moves, and thank you for sending in so many insightful questions. It is provoking me to, think about new ways to serve you in terms of all your questions reflective of your curiosity or a decision point. So let me start quickly. Aditya is asking that after SEBI's notice, what is the best multi-cap investor can do? Aditya, to begin with, do nothing, because this has caused a huge difference to the way the multi-cap funds needs to realign its portfolio. There are funds, which have to. There are big multi-cap funds, and they have virtually no investment in large caps. And if they have to necessarily invest 25% in small cap and 25% in multi-cap, that will completely alter the dynamics of their portfolio characters. Besides that, I don't think the small cap universe has that much ability or that much liquidity or depth to absorb that kind of investment in a brief period of time. So many, my expectation is that many funds will actually change their color. They will either turn themselves into a focused fund or a large and mid cap fund or something else. And some funds will change its complexion, and the ones which will change, they will not be reflective of a multi-cap in true sense, because the market, if I take the whole market cap and take the top 100 companies, that is about 73%, which means large caps are 73% of the market cap. Remaining 12-13% is 14-15% is about mid caps. And the remaining 11-12% is small cap. I'm just giving you an estimate based on BSE 500 breakup, and which is amply reflective of what mutual funds are invested in. Mutual funds total portfolio is spread over something like 857 funds, 57 stocks, 857 stocks, and that too you can drop the bottom 100 simply because they are there simply because mutual funds can't do anything about it. So the investable universe of Indian funds is very narrow, and from that standpoint, I think so. My clear answer to you is that do nothing for now. Funds have till January to figure out what they will do. Funds should be announcing earlier so that investors can decide themselves. And at Value Research, we will be telling you what to do with your different multi-cap, and it's of great concern to us as well, because I have been saying all these years like a stuck record that keep it simple, invest in few funds, and those funds should be multi-caps. And now there is a whole question about what happens to multi-caps. So we will be at it. We will be telling you what exactly to do with your individual multi-caps, and keep coming to Value Research Online to look for an update. We will be chasing fund companies to figure out what they are going to do with their multi-cap and how soon and what exactly. So keep in touch. Sanjeev Purohit is asking that what is the effect of SEBI circular regarding NAV on retail investor? What is the rationale for changing expense ratio very frequently as noted in my L&T mid-cap fund? And can't you show separate AUM for regular and direct option in Value Research site? Okay, the first question, these are three separate questions in a different context. SEBI has come out with a circular. So far, it was possible that if your investment is up to rupees 2 lakh, you can deposit a check, and if your investment is made or registered or time stamped before 1 o'clock, which is the cutoff time today, you get today's evening NAV. So your 1 lakh rupee minus the stamp duty, that amount divided by today's NAV is the number of units allotted. Now the rule has changed. That this rule was applicable to all investments earlier as well, for investments of 2 lakh rupees and more. Now it has become applicable to all investments in mutual fund. So whatever be your size of investment, you will be allotted NAV only when the fund company has received the money. Earlier it was possible for investments up to 2 lakh rupees that they haven't received the money. They have received an application before 1 o'clock. You will get the allotment as of today at today's prices, and they will realize the price in 1 day or 2 days. They will bank the check and they will realize the money. That it actually affects in no way. It has no bearing on the digital investments or online investment, because the online investment mandates that the money is debited from your account and credited to the fund company's account that moment itself with a timestamp. So only in the case of physical checks where you're saying, and it has no bearing on all your ECS mandate and other things, because they are auto debited from your account based on an instruction and enablement from your bank. So it affects only the check which you used to write to a fund company and go with an application form for your investments. So that's one. And it's a fair system. You should get funds only after you have paid the money and the fund company has received it. You writing a check doesn't mean that fund company has received it, and it is fair to all other investors. So it's good. Second is why expenses vary or change often. Simply because expenses are variable. Recently, 2 years ago, not 2 years, little less than 2 years, SEBI made changes about the expense ratio. That as the fund gets, the principle is that as the fund gets bigger, it should charge lower expenses, and the economies of scale should translate into some advantage for investors. So for up to 500 crore, mutual funds, equity funds are allowed to charge up to 2.25%. Corresponding number for debt fund is 2%. 500 to 750 crore, it is 2%. So it goes down by 25 basis point, 1/4 of a percentage for amount up to 10,000 crore. And and after that, for every 5,000 crore added, fund companies are supposed to reduce by 0.05%. So as the fund gets bigger, in the denomination of 5,000 crore, expense go down. That apart, so that is for the equity fund, and the debt fund is relatively lower. It goes down to a lower of 1.25% and subsequently 5 basis point thereon for every 5,000 crore. Now there is an additional thing. Of course, over and above this, there is a GST which is levied, which is 18%. On top of it, mutual funds are being incentivized to sell mutual funds. They are allowed to charge extra a maximum of 30 basis point if they sell 30% of their incremental sales. So if the new money being mobilized by fund companies from below 30 companies, below 30 cities, which is mutual funds where the regulator wanted fund companies to go and sell mutual funds far and wide, not only in the bigger cities where mutual funds were sold. So earlier this used to be top 15 cities. The incentive was for mobilizing money from beyond 15 cities. Now it is for beyond 30 cities. So if a fund company is able to mobilize 30% of their incremental money, new money, from cities beyond the top 30 cities, they can charge a maximum of 30 basis points more. So all this mechanism of lower expense for more money managed translates into a variable expense. And this variable expense, and SEBI has also mandated that whenever the expenses change or go up, investors should be informed. So you are being informed of all the rise in expenses for you to keep you posted. You can take a decision and take a relative view that how are other funds, what is the cost of other funds as compared to the funds that you have invested in. And third question is, why don't we show the AUM of regular and direct options separately? Simply we don't get it. The disclosure is not independent, is not made separately for these two plans separately, so we can't. Moving to the next question, Ashwini Agrawal is asking that I'm a retired person, 64 years of age. I want to invest in retirement corpus, my retirement corpus to meet my expenses between equity savings fund and balanced advantage fund. Which is better choice for me? If you have never invested in the past with anything which is market linked, I would say be conservative. Go with equity savings fund. It will yield lower return, but it will be far more stable. And if you are not going to be, if you were an investor, of course, you have clearly written that you need it for expenses. But if you have some other primary source of income, whether it be a pension or a rental income or some other source, and this is a supplementary source, then you can well consider balanced advantage fund. But if you have never experienced a market linked investments before, then I would say hold on for 3 years, then move there. Karthik Sri Kumar is asking that I'm planning to diversify my portfolio by investing in international mutual funds. Could you please advise if Motilal, Oswal, S&P 500 is a good bet? Yes, it is a good bet to diversify, but don't lose track of diversifying internationally. You should, and it is a very meaningful diversification. Most investors should do it. We have our jobs here, we have our investments here, we have all our assets here. We should have our investment which is not correlated. And I think they're also, but it should also be evaluated based on the investment merit, the outlook. What is the likelihood of they doing very well? And I think they also add very substantial value, because the kind of exposure that you get from some of these investments, particularly the NASDAQ 100 or the US Opportunity Fund or the US Domicile Fund, I think the kind of businesses they are global businesses. They might be domiciled in the US. They are product and services which are tech heavy, leading the world, cutting edge, so and high growth, and reasonably priced too, sometimes I find, as compared to many of the Indian peers of course, incomparable kind. So I would say that by all means diversify. It could well be 25% of your allocation, or equity money, or 1/3 or whatever. But be focused on performance. Evaluate them. Just you'll be evaluating a good fund for a performance in a full market cycle, with an eye on the outlook, that how likely they are to do in the future. Anand is asking that I read that lump sum investment in equity funds beat 66% of the times the SIPs in terms of return. Have 10 years plus horizon and more than 1 crore of rupees to invest in equity. In a rising market, should I do a lump sum investment, as they say, time in the market is more important than timing the market? I would say that it's a substantial amount of money. And if you're investing for 10 years, I would still because managing your own anxiety, managing your own moods and temperament, emotions, gets very difficult when you invest a large sum of money in a rising market, and actually soon after you invest, the market stops rising and maybe falls substantially, or gets into a free fall for a period. That's the time when you have great regret. That is the time when you get anchored to a price that, let my money get back to 1 crore rupee and I'll run. These are the emotional problems and challenges that you have to overcome. And so I would say that if it's a substantial amount of money, meaningful for you, if it is not, then by all means take the plunge. But you have the time on your side. I would say that spread it over the next 18 to 36 months. Even 36 is not bad, because no longer than 3 years ever, because you lose a good amount of time. But I would say that spread it over some period of time, because managing your own emotions gets very difficult with in times like this, if you are faced with a big decline. Suhas is asking that, is it good to add terminal illness rider and other riders to term insurance plan, or it's better to keep term insurance separate and have another insurance for terminal illness and permanent disability and all other needs? No, riders are good. Riders are cheaper, and riders are meaningful, and for a very insignificant cost, additional cost, I think it comes in very handy. Something happens to you, critical illness rider comes in very handy, because that is the money which most of the time the payoff of insurance is when you die. Here you have a meaningful payoff from an insurance when you don't die, but you are faced with a crisis, or you are faced with a misfortune, where that money helps very, very nicely. So I think go for this rider and take it additional to your term insurance itself. Excuse me. Arnab Bhattacharya is asking that, how will new asset allocation rules for multi-cap funds impact the overall small, large and mid-cap indexes? Will this make multi-cap funds better than before, or people to invest, or will it be the reverse? Should people book profits from their existing multi-cap funds before the changes are implemented? No, as I suggested earlier, that do nothing for now. See what fund companies are doing, because SEBI has also given an advisory that fund companies will be facilitated to deal with this situation by mergers, by realigning with different categories and other things. So wait for a while. Don't jump onto conclusion. What will be the impact? Yes, these something which remains in the multi-cap category to comply with the rules, it must have 25% small cap, and 25% small cap, 25% mid cap minimum, which has been mandated, will make it a little more volatile. potentially more better performing, potentially a drag on the performance, we don't know. And definitely not, it will not align with if we are actually looking at an all cap market. Of course, the funds, most multi-cap funds which turned big, they were guilty or they were non-compliant with, if at all, there was absolutely no exposure to small cap, and rightly so. Because if there's a 30 crore fund or 40,000 crore fund, and if you have to invest even 15-20%, that's a very sizable amount. That is bigger than most of any of the smaller companies fund that we see. So most small cap funds are smaller than the small cap allocation of some of these funds. So I think it's very difficult to manage that allocation to small cap, the one which is mandated in many of the larger funds. Wait for things to actually happen. And at Value Research Online, I will be personally keeping track of all this, because multi-cap has been a mainstream category. I've always been suggesting investors that keep your investment simple, have fewer funds, don't try to do a lot of gymnastics with small cap, mid cap, moving allocation, buying sector fund. If there is one or two fund that you have to buy, it should be a multi-cap fund. And if you are going to invest just 1.5 lakh rupees in a year, even ignore the multi-cap fund, get into a tax saving fund. That will get you the tax break, and you are invested, you are done with, and it is multi-cap. You have got the broad-based exposure to the market. Let's see how it happens, what happens here, and we'll take a call. We will give you an insight into how to deal with each of your investments, because some of these investments are very big. And you would have seen a new feature in our mutual fund insight, top 50 largest fund, equity and hybrids. We have created a special feature in terms of keeping you posted about, because that is where you have the highest interest. 65-70% of money invested in equity in this country is invested in those 50 funds. We are keeping a close eye on that, and we will just keep the magnifying glass there and keep writing to you if at all you have to take some action. Tushar Khatri is asking that how to hedge the portfolio for any adverse impact downside, unlikely downside like the coronavirus. How do professionals hedge? There are derivatives. There are, in the futures and options market, you have derivatives available which can, options available, or where if the market goes down by this much, it's almost like buying an insurance. You pay a premium for buying that option, and if the market goes down dramatically, you will actually get the value of it, or you get compensated for that going. And but I haven't come across too many investors who have been successful with that strategy, or that has been the primary strategy at work. I would say that go on Twitter and start following Mr. Nissim Taleb. He runs a hedge fund, and he has made a life of, he has wrote that famous book, Black Swan, which is about unexpected surprises that we get, statistically improbable things that happens to us. And he's of the belief that that is a risk, and that is a risk. There are a kind of risk for which we cannot be prepared. Statistically, it cannot be measured. You cannot anticipate those things. And of late, we are finding those unexpected, unanticipated things more often. So I would say that follow him. He runs a hedge fund, and he has made a fortune out of following that strategy, or implementing this strategy. You have to look at it like buying an insurance, that you are spending a certain part of your investment towards buying this insurance, and once in a while it will work out, and most of the time. So you can build a good portfolio, build a good long-term portfolio, allocate a small part, figure out your strategy, and think of it like a cost, exactly the way we do with term insurance, or the way we do it with our car insurance. Nothing happens, you drive safely, you don't meet with an accident, and the premium is gone. You pay next year. Likewise, you have to look at it like a cost. Don't try to profit from it. Don't try to profit on a day-to-day basis. You have to look at it in terms of a small price being paid to cover your ground, and in case of a big misfortune, you are compensated. Ashish Sharma is asking that I'm a 35-year-old NRI. I got introduced to Value Research in 2018, and it helped me immensely. In last 2 years, I have invested 65 lakh in mutual funds and plan to invest 35 lakhs in stocks using Value Research Stock Advisor. Please advise how should I allocate money to stock investment at a fastest speed, and I'll keep investing later. My first advice is that don't be in a hurry. You don't have to necessarily invest fastest. Subscribe to Value Research Stock Advisor. Read some of the columns and the way to invest that I have written, or some of the videos or some of the articles there. Spend a day. Tomorrow is a Sunday. Good day to begin that. Start with your best buys list, maybe, and start doing your SIP. And going by what you have stated, that 65 lakh is invested in mutual fund and 35 lakh to be allocated here. It's fine, a third of your money will be invested in mutual fund, but don't be in a rush. You have to invest gradually, even when investing in stock. It will take some time for you to figure out how to do it. The mechanics of investing, you have this Zerodha and Grow and many other platforms which enable you to invest without incurring any brokerage instantaneously with your app. So move your money a little bit, maybe plan to invest, your incremental money as well as the 35 lakh rupees to be invested. Maybe it's planned to invest over the next 12 months, because there will be some learning involved. Which ones to buy now, which ones to postpone for a while, which one, and markets will be wild. These prices will be wild for even the company that we have recommended. None of the stock returns that you get will come in a very nice straight line going upward for many years. Of course, when you see it over a long period of time, 5 years, 10 years, 15 years, it will look like a nice smooth line. But all these nice smooth line over a long period of time come with a lot of intermittent ups and downs. And that is quite scary. So I would say that learn the ropes, do it with your 10-15 lakh rupees, spread it over the next 12 months, and then you will have the confidence. And that is what I did. When I set up Value Research, when I started Value Research Stock Advisor, I was preparing for it for last 2 years before that. We did not start in October 2017. We started preparing from 2014-15, made up our mind. We were running Wealth Insight anyway. I thought of, my first goal was to, do a very simple thing. All the recommendations that we make, I put a small money, 5 days, because that is what the law is. Laws prevent anybody from Value Research, who is part of the Value Research Stock Advisor, who is in the know. We cannot invest in those stocks the moment we make a recommendation. We have to wait for 5 days. And we also cannot invest 30 days before that. We will be charged of front running. So if I have a stock which has been held for a whole period of time, I cannot buy 30 days before, within 30 days of making a recommendation. So after 5 days, I put a defined amount of money in each and every stock that I recommend at Value Research Stock Advisor. But I have substantial amount of money. I thought that 25% of my net worth before that, which was entirely invested in mutual funds. By first year end, I will have 25%. Next year, second year, I will have 50%. I was not that meticulous with my own internal plan to replicate the stock advisor portfolio or stock advisor recommendations, but I'm getting there. I'm close to about 60-70%, and by the end of fourth year, I will be almost 100% in a stock portfolio of all the stocks in a limited amount, and dominantly 10 to 15 stocks which will dominate the portfolio, because I invest a fixed amount of money in each and every recommendation. I will still have some funds that is primarily because of the tax saving investment that I do, the 50,000 rupee NPS investment that I do every year, because I was trying to learn how NPS works, and 3-4 years back I was able to do entirely the whole thing digitally, and I have carried on. So, and I also will continue to make some investment before I get an opportunity to start investing abroad in stocks directly, which is also beginning to happen. But I will wait for 6-7 months or a year, because it's too complex. Every time I have to, because the additional problem is that I have to remit the money, and there is a tax deduction at source every time I'm buying foreign exchange and funding that brokerage account to buy that foreign stock. So I have carried on with the Nasdaq 100, so to say. So this is what it is, and I think having a methodical plan whereby you will be spreading your investments periodically over a period of time, and also learn on the way will be a desirable way. Bhaskar and Vasudevan is asking that I'm 65, I've invested some money in FDs and are due for mature shortly. Now that FD rates have fallen, what advice would you give? Renewal or other options? I'd say very difficult to find higher yields, but you are 65-year-old. There are some options only for old people above 60, which you are entitled to. Senior Citizen Savings Scheme, consider that if you haven't invested already. Maximum you can invest is 15 lakh rupee for yourself and another 15 lakh rupee for your spouse. Other thing is post office MIP. These are safest and highest yielding investment avenue, fixed income investment avenue for anybody in India. Of course, it comes with a rider of maximum and old age, a senior citizen. Then comes, I will have a recommendation only if you're not going to, if this is not a primary source of your income, because if you invest your money, and it is also a function of how experienced you are. Do you have any experience of investing in market-linked investment, any mutual fund or a balanced fund or a balanced advantage fund or anything like that? And if you are fine with the ups and downs, then it's fine. Otherwise, then only I would say that consider equity savings fund. They are a much steadier take on growth. They are the very small part, a third of your money will be invested in equity, rest in fixed income. Fixed income tends to be far more stable. Fixed income also potentially can give you marginally better return than fixed deposit. The third advantage of this will be that you're not liable to pay any taxes, or there won't be any TDS till you actually withdraw the money, because all your income kind of return when invested in mutual fund, though it is derived in the form of income, the underlying is of the nature of income, but it is treated as capital gains, which is very beneficial tax wise. So I would say that consider equity savings funds only and be very selective about it. There are a large number of funds, but all of them are not good. Very few are very good. Look at our best funds guide, maybe the premium account, as and when very shortly it will be up. You will be able to get good recommendations there. And if it's a large sum of money spread in 2 or 3, I don't think we have more than 2 or 3 to offer you, which we like. Rinit Ravichandran is asking that is PMS investment safe? Who should go for it? What are the pitfalls or risks of investing in PMS? PMS investments are safe because they are well regulated. It is managed by a professional fund manager, and because they have become big, they have SEBI is now taking a far keener interest in terms of investor protection, or the minimum has been increased. The way they are sold has changed. There's a restriction in terms of earlier they used to offer upfront commission. Now they have been stopped from doing that because it leads to misalignment of interest. But I would say that mutual funds score over PMS on variety of factors. One, they are very intensely regulated mutual funds. PMS can claim anything. They claim a performance, but PMS cannot actually make a claim of performance simply because PMS performance is different for each and every investor. If I'm a PMS client, I invest. You invest after one month. Because PMS is nothing but I'm delegating. I'm giving a power of attorney. I'm authorizing somebody to act on my behalf and trade everything. Then the tax efficiency bit. All the interim transaction that happens in a PMS is subject to taxes. Short-term capital gains you'll be liable for. When you invest in a mutual fund, and if you hold your mutual fund for 3 years, everything becomes tax-free. 1 year it becomes long-term capital gains. You are not liable for any taxes, whatever, even if the mutual fund is trading in day out. So tax efficiency is another factor, the interim tax efficiency. Because in PMS, all the transaction that happens, you will be liable for taxes. Third is, intensity of regulation. Mutual funds are supposed to, very tightly regulated because small investors are involved. The simplicity of it, the convenience of it, you can start with your SIP. In case of PMS, the ticket size mandated is very high. With your mutual fund, you invest and you take your money out, or you do your SIP of 5,000, 10,000, 500 rupees. 50,000 rupee. Expense is regulated, and it has to be uniform for everybody. Of course, it is not customized. So I would say that you are much better off if you can spend little time understanding mutual fund and choosing a good one. Use Value Research premium account as and when it's offer, yeah, and you will have great performers, great fund managers. Very unusual transparency that we witness. So go with fund and be little selective. That will be worth it. Chirag Manwani is asking that where and how much should an 25-year-old individual earning 2 lakh per month should invest, considering they plan to invest in NPS, individual and employer, and have 4 lakh in stocks and 6 lakh in mutual funds direct. Risk profile is moderately high, and current mutual fund, multi-cap, large cap, mid-cap, small cap, need help deciding step. I would say that devise a plan. It's quite enriching. Trying to have a roadmap for this and implementing it over your lifetime, and this will be very enriching. One is that if you are going to invest 4 lakh rupees in NPS, that's fine. If 2 lakh comes from your employer and 2 lakh is your contribution will be deducted from your income for computing taxes under section 80C and 80CCD. Employer contribution is contribution to you, but it is an expense for the employer and it is not even considered as your income. So this is effectively tax sheltered investment, which keeps growing, and it's your retirement fund. I would say that, the real steps to investing, long-term investing for a young person like you is pretty straightforward, because your tax saving thing is already covered with the NPS. I would say that what you should do is, ideally, if you had no investment, I would have suggested you that start with a multi-cap fund to begin with, not a balanced fund, because balanced fund is meant for somebody who is, because you have already invested. I would say that start with a multi-cap fund, and then get into more nuanced, have a larger allocation to small cap and mid cap over a period of time. And you are 25, you are earning well, but it depends how much you are able to save. Whatever you save, I think that's the first step. Then try your hand with stocks, but don't speculate. There are guidelines in terms of what you should not be doing. Stock investing is all about what not to do. And when you get into the market, the lure of everybody will be telling you some hot tip or something else, or something is happening in the market. There will be some momentum, and there is this F&O, which looks like easy money to be made quickly, and it turns out to be very dangerous or very harmful for somebody who is unable to spend time and have the trading instinct or the speculative instinct, or it requires experience. There are some people who have it, but majority of the people go there to lose money. Some people do succeed, but I don't know who are they, and if they succeed big time, they don't come and share their secrets. But we come across a lot of sorry stories or disappointing stories for people speculating in the stock market. So I would say that learn the ropes, get into stock investments, and keep it only to multi-caps to begin with, so that it's not taking a lot of your time. Keep doing that till you have the confidence. Learn, invest, formulate your principle. There are 10, 12, 13 ways in which you can actually, strategies which you can follow in investing in stocks. One is to look for growth companies, but they're always expensive. Look for companies which are growth companies, but they are available relatively cheap, or reasonably priced. They're not very cheap, but reasonably priced. Then you will have different things. Deep value stock, it requires a great deal of conviction and patience and strong stomach, because sometimes some of those stocks, they do well over time, but for 5-7 years nothing happens, and it is a test of your own grit that can you do you have some advantage, or looking for smaller companies which are growing very rapidly and shifting track as and when these keeping track of such racy stocks. Some opportunistic thing that happens, contextual things, something which becomes trendy, but those are very difficult strategies to follow. And there is a great deal of learning involved, And I don't think you can learn by just watching things, reading things. Of course, you can learn quite a bit by reading things and watching it, but doing things is actually makes you interested. Then finding good companies is one part of the story. How do you go about implementing it? How do you stick around with it? When do you get out of it? How do you overcome the anxiety? What do you do with a great company which you have spotted, and you still believe in it, but the stock price has gone down by 40%, and in a span of 7 days? How do you deal with that? So investing is so much about managing your own temperament. If you are able to deal with that, go ahead, do it. And but I think it takes time to learn it. So do it with 20% of your money, 80% is in mutual fund. As you gain confidence, increase your allocation to stock investments. Dinesh Patak is asking that in situation of rising tension and war-like condition, where can we park or invest our money with 5-year target? 5-year target for a non-negotiable goal. Don't look at war or the calamity or the crisis. We don't know about it. But I know of all the big wars that have happened globally, worldwide, and here. Of course, it has an impact. It has a short-term impact. I don't think beyond the world wars, anything had an impact. We had a lingering impact. Everything else had an impact for a couple of months. There's a saying that war actually creates an opportunity, an economic opportunity, because a lot of things get into production, and it's almost like Keynes' principle at work, that we start working harder, producing more for the war. But I don't think we are, it's very difficult to anticipate all these things. For a 5-year period, for a non-negotiable goal, think of fixed income only. For a non-negotiable goal, think of equity savings fund. 2/3 fixed income, 1/3 equity, non-negotiable. So 5 and 6 years or 4 years, if it happens early, celebrate, take your money out. If it is for a goal, for a very defined goal. So do this, don't worry about wars. Shubhendu Sharma is asking that not more than 25% of equity funds have beaten the index funds returns in the over the past 5 years. So the chances of anyone being able to zero in a fund which generates better return than index is 1 in 5. So why invest anywhere else? People invest simply because the lure of beating the benchmark. When you invest in an index fund, you have chosen to be an average, and everybody wants to really not be an average, be above average, and that is why you choose active fund management. That's one. The other is that looking at this point, it looks disappointing that many of course, large cap funds have the headwind. They are not beating the benchmark simply because they have the disadvantage of 1.5%. Even if all the large cap funds did generate 1%, 1.5% more, they will be able to match the index performance simply because that is their expense. Post expense, they will be able to match if they generate 1.5% more. So they have to do substantially more, and the universe of investing in a large cap fund is very narrow. What value can they add? So that is why we see the struggle. But I think at different point of time, multi-caps will look different. Also, I feel that index investing in India is not a very evolved part of the market. You have this Nifty, which is fine, which is replicable. We have enough depth. Going to junior Nifty, it gets very difficult. And going to small, we don't have a small cap index which you can invest in. You don't have a mid cap index that you can invest in. These indexes are starting. They will start, they will learn, and they will try to figure out, then it becomes a chicken and egg story. Till there are more funds which have money, we will not have liquidity. And if we don't have liquidity, those funds cannot be created because it's not very easy to replicate that index. So let's see how it evolves. These are early days for index funds in India. And I still feel that, active fund management still has, has hope and promise in India. And at this point, it might look not so rosy, but things change because the market has been very narrow over the last 2-3 years. Large caps, and that too a very small segment of the large cap, is doing well. Maybe little surge in mid cap and small cap, and you will see that most funds, the SIP 5-year SIP return will look very different. Most funds are beating them by a wide margin, and we see it every now and then. So don't go by the view which you get right now, because today it looks grim, and I agree with you. Manoj Kumar Agrawal is asking that why aren't the names of mutual funds made simpler for all large caps could be named the name of the AMC and large cap fund. Similar for all other groups to eliminate confusion and misspelling. If you were part of this committee. Oh yes, I am part of this mutual fund advisory committee, but I think SEBI in its at a certain level, this is the individual fund company's decision, and SEBI went about doing this reclassification to create homogeneous set of comparable funds. And the real problem was that fund companies were creating new and new kind funds which looked alike. So they wanted to create a framework whereby mutual funds don't launch too many new funds pretending it to be new while they were actually old or similar kind. So that is why the restriction which the rider which comes along with that these categories have been created and every fund company can launch one fund of this kind. So this was the problem that we were going to solve. We were not solving the problem of nomenclature, but at the same time I would say that there is a classification, there is a mutual fund category assigned to each and every fund that you see. So that is good enough. Value Research has created that category where you go to category return and you have all those funds which are comparable, even if they are called differently. And they are not very different. Some fund companies call it large cap, some fund companies call it blue chip. There are fund companies which call their mid cap fund a smaller emerging blue chip or mid cap fund. So yes, I agree that it will simplify, but at a certain level mutual fund is also a consumer product. People try to persuade you, try to impress you, try to name it. Otherwise, so they're just trying to make it interesting. Earlier, the focus on making it interesting was far more than actually managing it in many cases. But that's fine. I don't think that's a big problem dealing with it and the way you are being served the information. Arun Mohan is asking that you mentioned in your article today that it is good to have an allocation to value contra funds in the portfolio. How does one go about assessing such a fund, given that they make bets on stocks which their valuation is low? Yes, value and contra funds, they are different kind. Value fund are the ones which are trying to look for. Value managers' claim is that there is an intrinsic worth in his eyes based on the strength of the business or some competitive advantage of the business. Somebody thinks that it is worth 100 rupee and it is available for 80 rupee. That is why he is buying it. Contra is a slightly different, but we have clubbed these funds together and also SEBI has done it in its classification that they are out of favor. The market is of the view that these companies are not likely to do well and the fund manager thinks otherwise. He is taking a contrarian view. He thinks that these stocks are likely to do better for XYZ reasons, and the whole market is actually thinking otherwise. And there is a huge reward for if he's right. One, he thinks otherwise, and also if it turns out to be right, there's an outsized reward for this. Likewise, there is an outsized reward for being a good value player. If you are able to spot something which is worth 100 rupee and it is available for 50 rupee or 60 rupee or 70 rupee, in hope that the market will recognize at some point in future that it will be fairly priced, it will be fairly valued, then these fund managers make a lot of money. But the whole market, sometimes it tests patience. Market does not recognize. It just doesn't move. Or sometimes, the value manager picks a stock which turns out to be a value trap. They are at a discount, they are at a low price for a reason. And the market is unable to, reconcile to changing its view that, no, this is a great value, or they don't change their view on some of the contra bets. And it has been proved to be a test of patience for many of these funds. But I still feel that all segments of the market, whether it be the strategies or whether it be a part of the market or whether it be a different set of stock or different sectors, they are cyclical. They go in and out of favor. Something which is out, and there is a reversion to mean. And so that is why I feel that a small part of your money or a meaningful part of your money, it could be 10%, it could be 25%, it could be 35%. It should not be dominant because I feel that growth has far greater promise. But these strategies can also have some small allocation. And how to go about evaluating them? Look for a full market cycle performance. From a low to another low, or a market cycle is a rising market and a falling phase of the market. A full market or two full cycle of the market. And if you see that funds have done well, if you are picking them now, it could be Somebody else has done the waiting and you are coming at a different, at a later point. It can turn out to be rewarding. Genu, Jency, Tony. Oh, sounds like three names. How to know market is bullish or bearish in coming days? Because during these COVID times, market is going up. I thought it will go down in April and May. When investing in market for ordinary folks like us, stop thinking, make your plan and make your plan work. Work on that continually. Don't get distracted. Nobody knows. We couldn't anticipate the crisis. We could not anticipate the virus, definitely. And we don't know how bad it can get. We don't know how big a surprise the market can give. Market can stop going up or can, linger. The three things that can happen to market at any stage. It can keep going, it can go up, it can go down, or it can go nowhere. And if you are faced with this situation, what can you do about it? I think the only thing you can do about it is make sure that you don't need the money for a couple of years. So that's the first rule number one. But at the same time, we should have a belief that, beyond a point, it will go up, and that it always does, and it certainly will do. And it's a general bet on economy. That is a belief I have. I'm an eternal optimist. But about the precise time frame, 1 year, 2 years, 6 months, 1.5 years, I don't know. It's very difficult to anticipate. So, and it's not worth doing it. So let's do some simple things. Money that you need in immediate term, keep it in fixed income, be averse to any risk. And money which you don't need, start your SIP. If you have lump sum money, spread it over a period of time. And stop thinking about what is going to happen in the market. If at all you have some great temptation to benefit from some big moves in the market, maybe keep your 10% money, 10% of your money, whatever be the amount, scale of money investment, 10% of your money, and frame that rule that if the market goes down by 20%, you will invest half of it. If the market goes down by 30%, you will invest the remaining money. Because the problem of trying to time the market is that when the market goes down by 20%, you will keep waiting for it to go down further, and then it will suddenly make a comeback, and then you say that you will start waiting for it forever. We will keep waiting for the opportune time, and that is the biggest risk, and you will never invest. So I will say that for dominant part of your money, 60%, 75%, 80%, 90% of your money should be on an auto plan, automated. Very hard to guess the market. And a small part of your money, 10%, 20%, 25%, feel happy about it. Keep it in cash, keep it in a fixed income fund. Frame your rule. Market goes down, this is the day you will not look, you will blindly invest. If it goes down by 10%, but 10% from which level? Because if you wait for that 10%, because when the market is going down, market always has a very erratic behavior. Market goes up gradually, steadily. And when it comes down dramatically. Someday it will come down by 3%, another day it will come down by 4%. All the big correction, all the big declines happens in a very brief period of time, while most of the gains happen steadily over a period of time. So you don't know when the market rises, but you really know when it crashes. Have your rule, frame that. Otherwise, put all your money on a SIP, automate it. You will be on to some plan. Nishant Vadavan is asking that I want to invest 10,000 per month for my marriage, which is 3 years away. Kindly suggest where should I invest? Congratulations for your marriage, 3 years away, and you are a very organized person. 3 years away, you don't have much of an alternative. If your date is finalized and 3 years is frozen, then invest in equity savings fund. That is a conservative take. Maybe your contribution here will be 3.6 lakh rupees. And if you get some, by that time, if the market turns around and you're able to average well, maybe you will have some more money. And so do your SIP, 10,000 per month in equity savings fund. It will translate into something meaningful. And one unsolicited advice, all the accumulation that you have, you can actually get yourself a nice wedding gift by saving something from that accumulation. That will be a nice gift to have. Zareed is saying that in view of the proposed changes in Parag Parikh long-term equity fund, writing of covered calls option strategy in the scheme, is it safe for a fairly conservative investor to stay invested in the fund? No, this is a safe strategy because this is trying to derive a rent from your holdings in a stock. So covered call option is exactly that. You are lending a stock and writing a covered call. So, but the downside is that a certain part of the portfolio, to the extent on which you are writing the call, that cannot be liquidated. But the fund companies, sponsors themselves have their, 150, 200 crore investment in these funds. So it cannot be normally done by many funds, because fund companies do not have a control or have a control that all their investors will not turn up. Theoretically, all investors can turn up to take their money out from their open-end fund. So in this case, the fund company can actually do it on a 150, 165 crore, to the extent they have their own investment, and they can't really sell those particular positions. Vishal is asking, and so I would like to say that it's not a very risky strategy. It's trying to earn some extra income on a certain part of your portfolio that you have. Vishal is asking that I have been advised to start a capital appreciation STP from all mutual fund schemes into arbitrage fund, so as to invest the amount accredited in the arbitrage fund back into equity mutual fund schemes whenever the market falls. I don't know, this is too complicated. STP appreciation, I'll just explain you the principles, and it could be useful for other investors as well. This is like creating a capital protection structure for yourself. If you have 1 crore of rupees, you invested it in an arbitrage fund. Arbitrage fund produces a return of 6% per annum, which is, say, 6 lakh rupees in a year, maybe 50,000 rupees a month, for sake of, ease of calculation in my own mind. So if it is 50,000 rupees money getting generated from 1 lakh rupees, you will start doing a 50,000 rupee SIP in an equity fund. But, you have 1 crore of rupees of capital, and only 50,000 rupees is going to work. One principle which we should not, so it depends. If you are an extremely risk averse person, you don't want to take chances with this 1 crore, this is something which you really want to be very careful about, then it's fine. This will optimize your return, because your 6% getting into equity will translate into something meaningful over a period of time, but it will happen gradually. Only 6% of your money is getting more productive incrementally. But imagine, if the difference between fixed income return and fixed income return, which I mean the arbitrage fund, because arbitrage funds, in terms of return, they will be nothing little more or less than liquid fund in future. So if liquid funds are going to generate 4-5% return, and equity is going to generate anywhere between 10 to 13% return in future, this is a differential. So your 1 crore rupee will be earning that 5%, and the return which is generated on this one will be generating very small amount of money, which will generate high rate of return. Think of some other thing. Think in terms of making an allocation and not looking at it every day, because this is a strategy which is to deceive your mind that your capital is protected. But you have to do it differently. You can invest 40% of your money in equity and think that in 5 years time this 40% in equity might not do well, but this 60% which is invested in fixed income will appreciate. So at least you run the possibility of generating higher return, and there are other permutations, combinations possible. So all the best, try it out, and try to deceive your mind to navigate these markets better, which is generating more return. So thank you all for writing in, and I'll come back next week again to answer all your questions.